Okay, well, welcome everybody. My name is Natasha Phipps. I am the CEO of WealthShare. We are a real estate investment trust or a private REIT, and we are located in Calgary, Alberta. And this is one of our value add type of events. We like to bring content to our investors and to the investor community, period, that is hopefully going to be very helpful for you guys. And there's a lot to talk about in the commercial financing space and lots of ups and downs. And it's been definitely a very much of a roller coaster here over the last year. So we're going to dive into it all. If you have questions, we do want to hear your questions, and feel free to use the chat as we go along. So before we get started here, I am just going to put up quickly. Can everyone see this WealthShare document here? Yeah, good. Okay, good. All right, so just to be clear, tonight's presentation is we're not here to give you investment advice. This is for educational purposes only. And of course, if you have any questions, please reach out to us. And if you want to review this disclaimer, it is linked on our website, wealthshare.ca, if you'd like to review it in detail. But that's it for the legalese. Very quickly, many of you know who we are here at WealthShare, but I quickly want to talk about who we are and what we do before we dive into the meat and potatoes of tonight. So as I said, we are a real estate investment trust, and our mission is to provide passive investment opportunities for investors wishing to invest in the multifamily space, particularly here in Alberta right now. That's where we are focused. That's where a lot of people are focused. That's where the deals make sense. And also there's just a lot of benefits to investing in Alberta, particularly when it comes to multifamily real estate. We have some huge advantages here in Alberta that make these deals a little bit more lucrative. And so that's why we are focused here in Calgary as it is. Very quickly, I'm going to talk about the offering that we provide, just so you know a little bit more about the opportunity you might see with WealthShare. So this is our offering summarized very quickly. We are open to eligible and accredited investors, subject, of course, to compliance securities laws. We accept investments starting at $5,000 and up, and you can use your cash or registered funds, which is really exciting. And the registered funds component is a big reason why we went with the REIT structure to purchase long-term buy and hold real estate in Canada and use registered funds. This is the vehicle to do that here in Canada. So that's why we went down that road. We are raising funds by way of offering memorandum, which does also allow us to open the doors to non-accredited or eligible investors. So all of those things were really important to us. We want to be as accessible to people as possible and provide beautiful institutional quality level assets to our investors without having to do all the work yourself or go and raise the capital yourself. So benefits there, we're pooling our nearly 200 investors now resources and to be able to buy the type of assets that we're all really interested in the multifamily space. With these assets, we are providing a 8 to 12% annualized return. So we offer an 8% preferred return with a 12% projected return. Any questions about any of this stuff, guys? Of course, we can answer those at the end, but I did want to make it clear what WealthShare's mission is, and that is value-driven type of opportunities and accessibility for Canadians to diversify their real estate portfolio passively. So that's enough about us. I can answer any more questions at the end. I'm just going to stop my screen share here and introduce our main speaker this evening. So we are joined tonight by Brennan Yadlowski from Avis & Young. I have added him here as a spotlight. Hopefully everyone can see both of us. And Brennan has been instrumental to the WealthShare team over the last year in acquiring, refinancing, our first two assets into our portfolio. So thanks so much for being here tonight, Brennan.
Thank you, Natasha. I really appreciate the introduction and the invitation.
Awesome. Well, everyone's very excited to hear everything you have to share this evening, I'm sure. So before we get started, can you just give us a little bit about your background so people know who you are? Obviously, you're with Avis & Young, but can you tell us a bit about yourself?
Absolutely. So I've been with Avis & Young for over 5 years now. I started in Edmonton as a part of the investment sales, so income producing assets We would sell, to REITs, to private buyers, all across Alberta. I also at that time was working on the mortgage brokerage team. So what I'm doing now, so I came in working on 2 teams, saw, double the amount of deals, and 3 years into my career in Edmonton, I moved down to Calgary to run the Calgary office of the debt and equity finance or mortgage financing team here in Calgary. So currently run the team down here. We are licensed across Canada, so we can finance assets in any province or territory in Canada. So I've been doing it again for 5.5 years. I have a team of myself and 3 other brokers, an analyst, and another associate up and coming here. So, like I said, we service. We're called the Western Canada team, but we service every province and can help borrowers purchase properties in any province.
Awesome. Thank you. Well, thanks for moving to the better Albertan city. Sorry, Edmonton.
We're a hockey team,
out there.
We're a hockey team, better real estate. Yeah,
that's right. I had to give Brendan a hard time there. Thanks so much. I know everyone in the real estate game we're all drowning in work right now. So I know how valuable your time is. So thanks so much for being here. I think in our audience, we're going to have a wide range of investment levels sort of watching this webinar. So at the very beginning, I just want to kind of bring it to the basics first and discuss key differences when it comes to getting into the commercial lending space that you are educating your clients on when they're first getting into this space, when they're coming from residential and they've, done deals there, but it is very different, of course, getting into commercial. So what do you tell those clients first getting into this?
I would say the biggest difference, Natasha, is how the qualification works, right? Coming from residential, you're used to being, what they call pre-approved, based off of your income, your debt levels, your GDS, TDS ratios. Commercial, there is none of that, right? It is based off of your personal net worth, your liquidity, but a big indicator on the commercial side is the performance of the asset, right? And how that asset itself can cover the debt service. Right. So, everyone asks, what am I pre-qualified for? Can I buy a $3 million property? And the answer is always, well, it depends on the property, right? And how that property is performing. Of course, there is a big part of it is yourself as the borrower, right? And what your net worth looks like, what your liquidity looks like, your experience, right? Your property management experience is important. Or on the residential side, even if it is, 1, 2, 3, 4 unit investment properties, those are still qualified differently than 5 or more units, right? So the biggest thing is just how it's qualified. Process can take a little bit longer because again, there's more due diligence that has to be done with the property, right? Sometimes on residential, you can get away with just inspection done. You will need a phase 1 environmental and commercial. We may need a building condition assessment, which has to be done by an engineer, not just a certified inspector. So that will take a little longer too. So it's and then also you'll require an appraisal on the majority of properties in the commercial world, right? Yeah. So and then of course valuation of the assets as well, right? And we can get into that too, but valuation of commercial assets is based off of the net operating income, right? Which is composed of the tenants, the rental revenue from tenants, and then subtracting the operating expenses, right? Yeah. That's your net NOI, and then from there, the valuation is then based off of a capitalization rate, which a cap rate it's a valuation measure that's calculated by the ratio of that NOI and what the market value is, right? So there are market cap rates in every market that appraisers and lenders and buyers and sellers will use to evaluate the asset. There still is a direct comparison approach, which is very similar to the residential world, which is mostly based off of comparable sales, right, and what those have sold for. So that is also used in commercial financing, but that's another big difference is that cap rate, because it is the income that drives the value in commercial.
100%. Yeah. As my day job as a realtor, I spend a lot of time in conversations with people moving from residential over to commercial. And I like that you mentioned net worth right away. Like I will ask people that, and they often go, well, it only depends on how the property is valued. I said, well, no, like this is still an important figure. So I like that you mentioned that fees and costs, like the due diligence period is significantly more costly, potentially, most likely, compared to residential as well. So you could be, having these expenditures going out and then get through due diligence and be like, well, this isn't the right one for whatever reason. And those are just costs incurred. That's kind of the cost of doing business. That's a big difference.
Right. And that goes back to those third-party reports, right, Natasha, right?
Yeah.
Spending, you can get an inspection done for $500 and, your legal might be $1,000 when you're buying a residential property. Commercial appraisal's $3,000, phase one, $3,000, BCA's $3,000, that's $10,000 there. Right. And then depending on how big your loan amount is and the diligence required, legal fees as well. You have to pay for legal fees on the lender side as well in commercial. So
Yeah.
that is something to, again, keep in mind. Your closing costs are, quite substantially higher than in residential as well. So that's a very good point. Yeah.
Do you give a percentage, like when people are first starting out, of what they should, expect for closing costs on the loan amount?
So there's the flat fees with the third-party reports, we usually budget 10,000 there.
Yeah.
Legal, again, it kind of depends on the loan size, but for total closing costs, we usually say around the 1.5% mark of your loan amount is usually a good gauge there. Total all in. Of course, when you go through CMHC, there is another aspect there, which we can dive into. Of course, we will. There's another aspect there when it comes to fees and premiums, but those total closing costs, just, straight up between broker fees, lender fees, costs of third-party reports and legal fees for both yourself and the lender, usually about 1.5% of the loan.
Right. And also commitment fees. You can have fees kind of earlier in the transaction compared to what you would have in residential, right? So yeah, just a lot more to think about there, and a lot more costs just to review the asset is the main thing I wanted to kind of drive home there as well.
That's a good point. Yeah, if you're not CMHC insured, you will have a commitment fee from a lender.
Right. Which a lot of people use as a bridge if they're going to, be renovating a property or fixing it up, or if it's just improving management, they're going to close with that bridge loan, and you'll have those fees up front there.
Exactly.
Okay. You mentioned quickly cap rate. I want to go back and have you say that again. As I said, we have people brand new and people that are veterans, so I know the veterans don't necessarily need to hear this, but even here on the residential side, people kind of throwing this around, and why is the cap rate important? How should an investor be, watching cap rates and interpreting them from the investor standpoint?
Right. So very, very high level, cap rate is the return of the property, right? So cap rate is, like I said, that valuation measure, which is the ratio from the net operating income and the current market value. So very high level, that is your return, right? So to put it quite simply, if your NOI is, let's say 450,000 and you have a 4.5 cap, your value is 10 million, right? So that's just your return on what that value is.
Yeah.
And it's important because, that, like I said, that's how an appraiser will value a property based off of market cap rates, right? So when a property that's, say, in Calgary, and it's a 5% cap rate, in BC it might be 3% only, or Vancouver might be 3% only. So that's what's driving up the difference. It's going to be, if the NOI is the same, right? If it all else is constant and the cap rate moves down, then your purchase price and your value will be higher, right? So what's important there is if your interest rate is lower than your capitalization rate, there may be some negative return there, right? So that's important to think of as well, is if interest rates are 4% right now, can I really buy a property that's only a 4.25 cap rate, right? Because that's my return and I'm paying this interest, right? My mortgage payments are X, my income is Y. How does that work? So very important in evaluating your market value of a property.
Awesome. Thank you. Oh, I lost my list here. So this is probably going to be, our largest topic and what everyone's most excited about, which of course is CMHC. and the constant moving target that is there. But let's go really high level. What is, CMHC for at the end of the day? Like, what is their mission? and it does that align? Maybe not always, but let's explain what they are actually there for first.
Right. So the Canada Mortgage Housing Corp, their mandate is to provide housing and insurance to lenders and to owners of real estate. Right. So their mandate is to provide affordable housing, to provide insurance on mortgages for both the borrowers and the lenders alike. Right. And basically, they are a crown corporation, created by the federal government to oversee mortgages. They also administer the CMB, so the Canada Mortgage Bond, as well, which is what all CMHC insured financing is based off of. This is what the lenders are pricing their interest rates off of. So that kind of a mortgage bond pool is money raised by CMHC that the lenders then can borrow from, and they price off of that for their interest rates that they lend out to the borrowers. So MLI, so many people may have heard of MLI Select or MLI Market. What MLI is mortgage loan insurance. So CMHC, they are the ones that insure the loans that the lenders will lend on, essentially creating a very close to a risk-free asset for the lenders, right? Because if anything happens, CMHC's insured it, so they're backing it, right? CMHC also does act as a lender and act as a, they act with giving grants out to people that want to build or buy affordable housing. That's a smaller part of the business. The biggest part of CMHC is that MLI program, where they're insuring the loans that are then lent out by the lenders to the borrowers.
Perfect. Okay. And so if I'm looking at an asset, I want to go to CMHC for what reason? What is the benefit to me as the investor looking at a CMHC insured mortgage?
The biggest benefit is much lower interest rates.
Yeah.
Right. That is the biggest benefit. The second biggest benefit is the leverage. That loan to value can increase much higher than a conventional commercial loan. And then the third big benefit is that amortization can be extended out as well with CMHC. A regular commercial loan on a multifamily property that isn't brand new, amortization is only 25 years. With CMHC, you can get up to 50-year amortization, right? So that's because they are providing, you essentially are getting, a certificate of insurance from, de facto, the government insuring that loan. So lenders are able to, lend money out at a much cheaper rate. And also they're less risk, there's less risk because it is insured, so they can go higher on that leverage, right? So a typical loan to value, again, 75% for a commercial loan, you can go up to 95% with CMHC's MLI program. So those are the three main benefits: is lower interest rate. Right now, it is significantly lower. 5-year fixed terms with CMHC are very close to 2% lower than not CMHC insured loans right now.
Yeah. Perfect. One thing I want to add here for clarity, and this comes up in a lot of conversations I have with people, is loan to value does not mean loan to purchase price. And that is a big lesson and difference that is really important, that people, I think, when they're looking at a deal, they go, oh, okay, they're asking, $2 million. They calculate, well, I only need 5% on my $2 million, and I'm going to go buy this $2 million property, right? That's not necessarily impossible, but it's not, that simple. So I'm sure you run into these conversations yourself, right? So can you talk about that a little bit, and where the discrepancy comes in, and what's maybe a more realistic approach to look at?
That's a really good point, Natasha. So yes, CMHC will lend on up to 95% of their value, lower of that and the purchase price, right? So if the value does end up being higher than what you bought it for, you still can't go above that purchase price if it is a purchase and not a refinance. So that's an important point too. But the big difference with CMHC, and why that's, sometimes their value can be lower than the purchase price, is they have their own operating expense benchmarks, right? So what they'll do is they'll take the actual property tax, the actual insurance, and the actual utilities of the property, but then they have their own benchmarks that they do not move on at all for repairs and maintenance, management fee, the replacement reserve they also add in, and they also have a miscellaneous expenses. So they have their own, it doesn't matter what the property actually has for operating expenses, they have their own benchmarks, but they will, the three property tax, insurance, utilities, they'll take the actuals. Other than that, it's all their own. A lot of the time, those expenses are quite a bit higher than the actual expenses of the property. But the way they look at it is, if we have to take the property back, this is how we would run it.
Right. Yeah. And why that's so important to understand is the expenses are going to determine your valuation, right? Because they're going to impact your net operating income, which is then going to determine your value of your property, which is what CMHC is going to lend on. And so these benchmarks as well, they are revised annually, right? And so they can obviously change. Or could be revised, they can be.
Yes. Yeah. They usually change them every 2 years. And this last time actually took them 2.5 years. So they just changed them on June 19th this year. So just about 2 months ago now. They only went up about 5-6% from 2022 numbers. So not a huge increase, but when not all, they are also backward looking on the rental rates as well, right? So the rental rates come out once a year, the new updates. They include every vintage of property, so 1950s build and 2023 build. And they also are backward looking to October of the year before, they come out end of January.
Right.
So that's important to note as well, as when their rental updates and vacancy rate updates come through. But the operating expenses do change every 2 years. Yeah.
But the vacancy and the rental rates would be annually.
Exactly.
Right. Okay. And that was one of our big, lessons learned, roadblocks. I mean, there wasn't a lot anyone could do about it, but it was a significant change for us in our analysis, because on first acquisition of the Bergen, the CMHC vacancy rate was sitting at 3%, or I think it was around there somewhere. By the time we went to actually refinance a year later, the number was significantly higher. It had doubled, even though Calgary's rental market had significantly improved. And so that was an area there that, changed our valuation big time. And so, that lesson that we learned is like, be conservative, be even more conservative, because you don't know for sure if you're going to be caught in between these two times, for sure what that number might change to the next year. And I think at least all of the, things I go to, I don't think enough people talk about that change that could happen over that timeline. So depending when you acquire and when you refinance or whatever, those numbers could look very different and could impact your takeout at the end. So, and the other interesting thing that we talked a lot about was why CMHC considered certain areas in Calgary higher vacancy than others. Like, it makes no sense as well in some cases, right? So some of it is like, this is just the cards you're dealt, and you have to just also deal with it. And they have different vacancy rates per zone in like major cities, right?
Exactly. Yeah. And that was a really good example of just really bad timing, because where the Bergen was located, there was 3,500 units that came online about 4 months before we went to CMHC, and some of those had just come on and weren't leased yet, right? Yeah. So it was just such bad. Or
under construction.
Or still under construction, but they were technically, out in the market. And so it really skewed the numbers in October of 2022, which is when the Jan 1, 2023 numbers come out. So again, next year, unfortunately, I hate to say this, Natasha, but I'm sure next year when the new numbers come out, our vacancy would be right back down. Yeah. But because all those units have been leased, right? So
yeah, no problems, leasing them up. And so on the CMHC website, there's a map. We're not just talking about Calgary, we're talking about like cities, and there'll be zones, and each zone has its number. And like, it was interesting for the Bergen, if it was literally like 2 doors down, we would have been a different zone. The number would have come out very differently. So that map is on their website. So really good resource if you're, running numbers anywhere, like go and get the actual CMHC rate. don't just use like I see a lot of investors use like a general Calgary rate or a general Edmonton rate. Like go get the zones rate. Don't just take a sweeping approach to the whole city, right?
Exactly. There's some great information on that interactive tool they have there as well, above just vacancy rates. But that's a good point, Natasha. When you're in the major cities, it's definitely worth going right into your zone. You can dive right down in neighborhoods in some of the, better market neighborhoods. You can dive right down into vacancy rates for every unit type, right? 1 bedroom, bachelor, 2 bedrooms, 3 bedrooms, right? You can go to year that they're built, right? You can go to the style. Are they row townhomes or are they apartments, right? So it's important because CMHC will do that, right? And if you just put that blanket, oh, Calgary was 2.2 last year. Well, that may not be true for your specific asset, the underwriter.
Exactly. Yeah, exactly. Okay. Awesome. Actually, I just thought of one question. This was not on our list, but how does, just because you brought up major cities, how does CMHC look at like using CMHC insured products in smaller centers compared to major centers?
That's a really good question. To CMHC, they do want to insure. To them, it doesn't matter what market it is. The lenders, that's a different story, right? So CMHC does not mind a tertiary, small town. They want to insure properties there and for there to be affordable housing in every town in Canada. But the lenders may price them differently in those smaller markets just because there still is a little bit more risk to them, even though they are insured by CMHC in those smaller markets. So yeah, that's a good question too.
Yeah, that makes sense. Okay. Awesome. Moving on. Bond rates versus interest rates. And well, why are bond rates important, first of all, in the commercial lending environment? And how do they work differently than interest rates in terms of where the rate sits, and how does that work? Can you explain that?
Absolutely. Touched on it quickly on the CMB, the Canada Mortgage Bonds that CMHC administers. So why they're important is because that's what the lenders, that's where they're getting their pool of money from, right? And then they have to put a spread on top of that, right? So the bond rate, the CMB bond rate, which is usually at a small premium to the Government of Canada bond rate, because the investors are, different types of investors in the CMBs. And then the lenders will securitize the loans and put them into those CMB pools, which is where they got their money from. That's where they got their spread over top of that CMB bond rate. So the bond rate is what your interest rate's derived off of, right? So bond rates are important because that's where the lenders are getting their money. But of course, the lenders are going to make a small spread for themselves. So yours will be your interest rate that you're given is slightly higher. So
right.
that's where bond rates come into play.
Okay. And the other thing too is in terms of process, so we go through CMHC, we get our certificate of insurance, then what happens?
So once we have that certificate of insurance, that's when we get to go to the lender market, talk to all the banks, credit unions, family corporations that lend CMHC money. And that's when we start to get our offers, right? And the offers are going to be based off of a spread over that bond rate. So what you can control is the spread you get from the lenders, right? You obviously can't control that bond rate. That's all dependent on the market. But what you can control is how small of a spread you get priced over that bond, right? So we take that certificate of insurance, we take it to the lenders, we say, hey, we're insured to X loan amount. What is your offer based on the borrower, location, property, age? There's a lot of factors that still goes into the pricing for each individual lender. And that's what you can't control, is what that spread is over the bond rate.
Right. And just highlighting your rate is dependent on the bond market. It will do this. It will not be the same this morning as it was this afternoon. It's a very different game than in your residential pre-approval, where I'm going to lock in my rate for 3 months and I know I can go shopping, right? There is opportunities to lock in a rate, but that is a massive difference as well if you're coming from the residential space, because you don't really know unless you lock in what your rate is going to be until the day you close, right? That was another thing. Like I think we had like 15 minutes to like lock in your rate, right? And that was it. So can you talk about that a little bit too?
Absolutely. Yes, that's again, very, very important point. So you're able to lock in your interest rate once you have signed your commitment letter and you've satisfied the COI conditions. So you are able to lock ahead of when you're funding. You do need to put a deposit down. Typically in the market, that's 1% of your loan amount. You need to put that deposit down. It'll come back to you upon funding the loan, but you do need to have that liquidity to lock the rate. And so the timing is based when you sign the commitment letter, your COI conditions are all met, you're allowed to lock that rate. Again, like Natasha said, the bond rates can move throughout the day, right? We've seen them move as much as 10 basis points without a day. That didn't used to be the case this time last year. Market's a little more volatile now, but it used to only be 1 to 3 basis points a day. Now it's 1 to 10, right? Yeah. So it's very important to be ready to lock when you can. The other important piece on the interest rates is on your certificate of insurance, you apply with a ceiling rate, right? So what that means is that is the maximum rate that your property is qualified for. That's important with the debt service ratio, right? That your loan amount is qualified under. If your interest rate goes above that ceiling rate, you'll have to buy down your rate to that mark. So that does create some certainty, right, on what the highest your interest rate can be, right? But for everything below that, it does depend, yes, on the market. But if you go above it, you're going to have to come up with some cash, or your loan amount will come down based on what the buy down cost is. Yeah.
So that is another risk. I mean, it's so crazy because if you look at the bond market for like 5 years, I mean, the last year has just been a true roller coaster. It has truly been all over the place, and it was like so boring for so long. It seemed like
it was,
and now it's like every day is a new adventure a little bit. So those kind of uncertainties are certainly something that an investor needs to be prepared for. You have to have liquid cash available. I can't stress enough that you definitely may need to tap into some more liquid capital, even once you've gotten to your COI, once you've gotten to this point, because that may very well come up. So awesome. Thanks for explaining that.
One more note, just to kind of tell you what market we're in with bonds. They're the highest they've been in almost 17 years right now. To your point, from about 2014 to right before COVID, it did not move very much.
No.
And now we are back to as high as they were back in 2007. They haven't been this high. So that just shows you what kind of market we're in.
Yeah, it's very challenging. Absolutely. Okay. We're just seeing if there's a couple comments.
I've got a question.
Oh,
hi, Brennan. Monique here.
Hi, Monique.
Brennan and I go a long way.
We do.
Brennan, can you just touch on the lender side? Because obviously from the experience that we had with the Bergen, when we went with one lender, and if we locked in a rate at that time period, the lender itself took so long that we ended up needing to go to an alternative lender. And it's just for everybody's benefit as well, is that when you lock in that rate, you need to make sure that you've got the cash available to put to the side, because it's tied. You won't have access to it. So if you need it for operational purposes, you need to look at alternative avenues for doing that, because it actually can tie you down quite significantly. But yeah, if you could just touch on our experience that we had with one lender and then we had to go with another lender and the timing thereof.
Right, of course. So that's a good point, Monique, because every lender is different in many ways when it comes to that locking in the rate. Some of them, will charge you per week till funding of how much that interest rate will cost. Some of them have hedge costs based on how far out the bond pool is that you're putting your mortgage in. So they're different on what their interest rate cost is and the maximum amount. There are some lenders that will only allow you to buy down a certain amount. And then, as to Monique's point, there are some lenders that are slower, and maybe you can miss the market, right, if they took a little longer. So it's very important to know upfront. And the unfortunate thing with our experience is we were told upfront that we could do a buy down, and we took it all the way up to national. They went up to Toronto and credit department, and they came back and said, no, you can't. So that's a very unique experience that shouldn't have happened. We were told one thing and another thing was true. But there are many lenders out there that allow you to do the buy down. They do it differently. Some of them you need to actually give the whole cash to the buy down. Other ones will just retract it from the loan amount, which is what we had on the Bergen, right? In the end, it was just retracted from our total loan. Other lenders, I just locked the interest rate this morning. We had to buy it down 45 basis points, and the client had to come up with 226,000 to buy it down. But they got to their lower ceiling rate, and that's locked in for 10 years, right? So your mortgage payments are lower. So essentially a buy down of the rate is just prepaying the interest over that 10-year term, right? Or 5-year term, whichever you go with. That's a good point, Monique, because every lender is different in how they allow buy downs and how much the buy downs cost. And their speed, of course.
Yeah, well, and until the deal is done, until it's complete, like there's variables that are constantly changing or could be changing, right? Like bond rates, like there's things that can happen, right? So that's a really key point to understand. That's so different from the residential side, because you're like, I got my deal, we're good, we're gonna close in 3 months. That's not what you can expect on this side. It's very, very, very different.
Yeah.
So,
even on modern CMHC loans too, even if you're buying an industrial building, it's very similar.
yeah,
right? You're not locked in until the day you fund or you lock the rate, right? Because those are also based off of the Government of Canada bonds or off of the lender's internal cost of funds, which move every day, right? So commercial is much different. Yeah.
Awesome. Is this good, guys? Is everybody enjoying this? Is this like interesting, helpful? Let us know if this is good. I still got lots of questions for you, Brennan, but I want to know if everyone is enjoying it and learning a lot. I hope so. Let's go specifically to MLI Select program. This is a relatively new CMHC program. So let's just give the kind of overview of what the MLI Select program is. Absolutely.
So the MLI Select program was created by CMHC to replace their old affordable housing program, MLI Select. The three main pillars of it are affordability, accessibility, and energy efficiency or greenhouse gas reduction, right? So this program is put in place by CMHC and essentially the federal government to enhance affordable housing, energy efficient buildings, and accessible buildings, right? So when it comes to affordability, it is based off of the median renter income in that market. So essentially your rents are on a certain amount of your units. If it's a brand new construction, 10% is the lowest affordability mark you would require. If it's an existing building, 40% of the units must be affordable to qualify at the very minimum. But again, and in certain markets, that affordability mark, which is tied to median renter income, it can be quite high. For example, Calgary, it's $1,737 per month. Anything under that is affordable. Edmonton, I believe it's $1,665, right? So there's certain markets that are higher than others. So it's important to look into that when you're doing your underwriting. The energy efficiency side is based off of the National Energy Code. And the good thing in Alberta and BC is our building codes are actually even more stringent than the Canada building codes. So it's actually quite easy when you're doing a new construction in Alberta and BC to get points from that energy efficiency pillar. Accessibility is a little more difficult. It'd be best to talk to an architect exactly about what goes into the designs, the universal designs, and the Rick Hansen Foundation. But essentially, you need to have 15% of your units as accessible, for wheelchairs. That can add, some cost to your project. But CMHC really does want to start to push that piece because we are at a, of course, affordable housing is a big issue in Canada, but so is accessible housing. So if you have accessibility, CMHC does really like that in approving your project. So there's 3 levels to CMHC. So there's 3 pillars and then 3 levels of what you can achieve. So if you just do affordability at the very minimum amount, you can still qualify for MLI Select, but you can only get up to 85% loan to value and only 40-year amortization. Right. If you get to that middle mark, say you do some affordability and you get some energy efficiency, you can get up to 95% loan to value, but your amortization is only 45 years. So it's a little tougher to get to that 1.1 debt service coverage ratio, which is your NOI and your mortgage payment, right? Your annual mortgage payment has to be 10% higher than your mortgage payment, your NOI, right? So, and if you do get up those 100 points, which is maybe you're doing the second level of affordability, which means you got 60% of your units are affordable, you've got some energy efficiency, then you can get to that full 50-year amortization and 95% loan to value.
Yeah.
So again, it was created for affordability as the main pillar, and then the secondary pillars are that energy efficiency and accessibility. It came out in March of 2022. They did a full review of it in March 2023 of this year. They said they weren't changing any of the guidelines, but they did tell some of us, I'm a approved correspondent with CMHC, they did say to us, they really want to keep hammering home that affordable pillar. You know, in markets like Vancouver and Toronto, some people were getting away last year with just doing energy efficiency. And CMHC doesn't want to allow that anymore. They want you to have at least a minimum amount of those affordable units on the majority of projects now. They also did, at that review, they did decide to increase the premiums. So the premiums, the insurance premiums have gone up from as the lowest was 1%. The lowest now is 2.55%. Those premiums are added to your loan amount and amortized over the period, but that still affects your mortgage payment, right? Yeah. So it's still important to be aware of what your premium is because it's added to your loan, which again increases your payment.
Couple little things to add and things that what were we calling them? Nuances.
Lessons learned.
That were, you know, really interesting. And I think when you're analyzing a property or you haven't done this before, of course you're going to learn so much when you go through it. But the point of us sharing this stuff, guys, is so that if you're doing this, you know, you'll know to think of this as you go through it. But let's talk specifically about the affordability factor and what that means and how long you're locking it in for and what that tangibly, you know, relates to, because us as investors, typically we're looking at a property, we're going to do a pro forma for, you know, for sure 5-10 years. If you're Monique, you do it like 40 years. And so what does that mean for me for the next 5-10 years?
Really good question. So when you're locking in those affordable units, they're locked in for 10 years. You can increase that to 20 years to get extra points if you just want to do affordability, but you're locked in for 10 years. You are able to year over year increase those units by CPI, so inflation, for rental accommodation in your market. So, you know, that's basically a lot of, you know, mumbo jumbo to say you're locked in, you can increase based off of inflation year over year, but it has to be for rental accommodation, which you can find on Stats Canada. And I can send that link out to you, Natasha, to share with everyone, because it is important, but it does also change every year and every month, right, where CPI is. So it is sort of tough to do that modeling over the long-term period. Is, you know, kind of the best way to do it would just be, you know, I can only increase by 2%, right? Because that's, you know, kind of the standard low inflation over historical periods, right? So of course it's a little higher right now, and in certain months it's been much higher. So I've had some clients that, you know, locked in affordable units last year and they were able to increase their rent 7% this year. Right. And I had other clients that was only able to because the next month in the market was only 3%. Right. And Calgary's had such a large increase in rents, and Edmonton as well. And a lot of major markets have. So this year there was a big increase in the rental accommodation inflation, but that might not be the case next year. Right. We've had that big jump. So that is a very good point to be aware of. You're not locked in at that exact rate, right? So you're not locked in exactly where you are, but that you can only increase those units that you got locked in at the time by that inflation mark. So you can't increase all the way up to that affordable number. It's only increased by inflation.
Exactly. So, and that is a key point too. So I think, you know, you can't just run your numbers at what the maximum rent you can charge. You have to look at the current rent roll and go, okay, what leases are in place? Because whichever units you're locking in, you can only raise those ones by this % every year, even if it's well below what the maximum rent you could charge for that unit is. So timing of your rent roll and when you lock this in is important, right? Because that will kind of be your base and where you're going to start from. And especially us, landlords in Alberta, we are very lucky that we are not used to rent control. It's important to understand this at the very beginning compared to if you're from Ontario, you're probably very used to this, or BC, where in Alberta, it's obviously not something we're used to. So thanks for explaining that. Does that make sense for everyone?
I can add something to this as well, based on the lessons learned, in the sense that when it comes to the affordability units that you've identified in the building, and you're now going to CMHC, you're now actually going to put in the rent roll because that's a requirement. What everybody needs to be aware of is if you're buying a building and you're not getting the maximum rent out of that building right now, and you can, by doing a little bit of liquid paint or something, and you can actually increase that rent. From an affordability point of view, you can actually still put on the rent roll, even though it's not rented out at that point in time, you can put on the rent roll just under the affordable amount. The only caveat is, by the time you go for closing on your financing, you need to make sure that you've got a lease agreement that has that value on it.
Exactly. Yeah.
That was a lesson learned that we had. And I thought it might be worthwhile mentioning it to everybody now, because otherwise you're going to get yourself into a trap where you've got a lease, for argument's sake, of $1,400, where you can get $1,700, and you put $1,400, and in the meantime, between the time that you go for CMHC and closing of the financing, you've had a new tenant coming in. Because you put that rent roll at $1,400 with CMHC, it's going to be locked in at $1,400. And you can only increase it by the CPI the following year, where you had an opportunity of just putting it on to say, well, I'm going to get that unit vacant in the next month. It's not going to close in 3 months. I know I can get $1,700 for it. So I'm going to put $1,700 as the market related. And by the time I close, I know I will have a lease in my hands for $1,700.
Yeah.
So bear that in mind when you go out for CMHC financing. Can you add to that, Brennan? Because I'm just putting lessons learned out at the moment.
That's fantastic. That's pro tip there.
Well, it is. And it's even more important now with you haven't even got to the timelines of CMHC anymore. It's even more important now when the timelines have gone from 4 to 6 weeks to get approved to 10 to 12. So we'll dive into that a little earlier, but to Monique's point, or a little later, but Monique's point is the projected rent roll is important. Again, that happens all the time with the construction properties. Before you go over your takeout financing, you're projecting what your rents are going to be, right? So it's better for you to go in with what you believe will be higher. But with where CMHC timelines are right now, they used to take under a week to get picked up by a document reviewer. That's taking now 6 weeks. What used to take 4 to 6 weeks to get an underwriter assigned after you get past that document reviewer is now taking 10 to 12. So we're estimating now, what used to be a 2-month timeline is closer to 5 months. So that's important when you're doing your analysis of when you're going to be going to CMHC on your refinance, right? On you're increasing your rent roll. It's okay to go in a little early right now, as long as you can truly get those market rents, right? So that timeline is very important. So that's a good point by Monique. And they did change that rule actually a few months ago, that what you submit your rent roll at, that's locked in.
Yeah, that's a massive change. Sorry.
Yeah, I was just going to say, you mentioned this earlier, Natasha, but I think one of the most important messages here is it's not done till it's done. Like, I think like you've touched on it already. One of the biggest changes between residential and commercial is that like it's not done until it's all done. So you have to be prepared for every moving variable, and be prepared that what you're deciding on, what you're evaluating on in 5 months, a lot can change. So the old "don't count your chickens" thing. It's exponentially more important to keep that in the back of your mind. And that's just one of those messages I think that needs to keep kind of getting driven home.
Yeah, Absolutely. Good point, Rodney. Well, and just for the Winston acquisition, we closed on that May 1st and we were on it. We were like, within a month, we had our CMHC application. I think it was just over a month. And we felt confident where we were, our rent rates, we had everything turned over really quickly, got it in. And then this announcement, of course, about CMHC premiums going up. And now there's just a flood of files in. And so, you know, our initial timeline for our initial bridge loan has now doubled. So those costs, there was no way to know for certain, you know, back in February or March when we were looking at this acquisition that would be happening, and it wasn't even really on the radar. But then all of a sudden these changes happen, right? And there's nothing you can do about it. You have to, you're playing the game. You have to be able to kind of roll with those punches and be able to adapt and have the capital to do it. So that's a really, really key one. Deanna asks, Brennan, can you change which unit is your like lower rental unit or your affordable unit?
Yes, Tiana, very good question. So after you funded your loan, your interest adjustment date, which would be the next day of the next month you funded, you are able to change which unit is affordable as long as it's the same bedroom type, right? You can't take what used to be a 2-bedroom, that was your affordable and you're making a 1-bedroom affordable now. It has to be the same unit type. And you can do that annually as long as it's the same bed types. So yes, you can. Very good question.
A good question. Just to wrap up kind of CMHC and timelines. Obviously we know timeline for actually getting your certificate of insurance, and that's a big, long moving target right now, but it's a significant wait. What then do you tell your clients? Okay, so once we have our COI, here's on average how much time we're looking to then close and get our CMHC loan in place, CMHC insured loan in place with whichever lender we choose.
That's a great question. And again, it has moved out now quite substantially. Used to take, 3 months used to kind of be that baseline. Again, every property is different on how many units you need to roll over, what kind of improvements you need to do, right? But now CMHC is probably taking 5 months for approval. And then after that, it's taking another month to 6 weeks to fund with your lender, right? So again, every property is different on how much you need to roll over. What's an example? You guys did a great job of getting those leases done quickly. So 6 months ago, we would have probably already been funded. But now because CMHC has delayed their underwriter queue so much because of the influx of applications, now we're probably closer to a 6 to 7 month all in to get through CMHC.
Yeah. Okay, perfect. Lori May has a good question. She said, can you touch on going from a private mortgage, that's basically what we're doing, to a CMHC insured mortgage? So you're going to be refinancing. She said, I understand you must first be with a lender on an approved list.
So that is a very good point. And I have this on my list of possible changes that have come to CMHC. And CMHC is ever changing, and they're changing this year more than ever because of the market, right? And there's a lot of dynamics that are moving. So just over 2 years ago, CMHC came out with a new rule that they will only refinance from their approved lender list. When that happens, a lot of the bigger companies that aren't on that list that do bridge loans came to CMHC and said, hey, we're not on the approved list. We don't want to do CMHC financing. We just want to do bridge loans. So we need to become approved. CMHC at that time said, no, you're fine. Some of the large, there's billion-dollar companies that do bridge loans and they don't do CMHC insured. They're private. About 2 months ago, some of these larger companies started to get CMHC to not approve the refinances. CMHC hasn't really come out and said anything about it, but some of the other larger lenders are starting to go through the approval process now, and they're quite mad because they've had clients that had, 10, some of them had $100 million loans that weren't able to be refinanced because CMHC out of nowhere just decided to change that rule. So it's not official yet that you can't refinance from a private lender. I've done many in the last 6 months still. But that being said, there has to be a story told to your CMHC underwriter of why I had to go private, right? Winston's a really good example of why we had to go private. We had 30 days. Right. There's no way we could have got through CMHC.
Yeah.
Yeah, right. It's a court-ordered sale. and it's a newer construction, right? They went through the court. That's an example of will be fine with a private lender. What they don't want, and this is the reason why they changed it, there's a lot of people buying in the provinces that have the rental cap rules, right, in BC, and they're kicking out tenants, right? They're bringing in much higher rental rates, right? And they're doing that sort of refinance program, which CMHC does not want to be an advocate for anymore, right? Of increasing people's rents by 250%, right? They want affordability, right? So the reason why this is one of the ways they're able to do that. It's a little hard for them to control what the borrowers are actually doing, but one way they can is, well, I don't want you to go get a loan from your brother to buy this property, and you kick out all the tenants, do some renovations, and then refinance you for double what you paid, and you kicked out 30 tenants, and now it's 250% higher the rental rate. So that's why they're doing it. On new construction, it's been okay if you have private lenders, because obviously, a lot of construction loans aren't with CMHC approved lenders, right? Court ordered sales are a good example as well, because you don't have the time to close. So the right story has to be told, but they just don't want to do any of these. You've held the property for 2 years. It was private mortgage with a mom and pop, not an institutional lender. You kicked everyone out, did these renos, and now we're going to give you more than what you paid for it. So that's what's happening there. So it's not necessarily true that they have to be approved, but to really limit your risk, if you're going to go through a program like that, I would recommend going through a CMHC approved lender on your bridge loan if you're looking to do that sort of rental program, because there's still there's a lot of properties that need that, right? So you shouldn't do it just because of this, but maybe let's do an improved bridge loan or bridge lender.
Good question. Simrandeep said, is there limitation? And yeah, we're at the top of the hour here. So, but just one more question, with respect to affordability when it comes to short-term rentals. And I mean, I know the answer, but I'll let you explain that.
Yes. So CMHC does not do short-term rentals. They only do long-term rentals. They also don't do bulk leases. So you lease a bulk of, say, 10 units to a corporation that then leases to their employees. They also do not like furnished units as well, right? So no furnished, no short-term rentals, and no bulk leases. You can get away with some furnished units, but they will discount your rents substantially, like by $300, $400.
Yeah.
So it brings your value down. So yeah, short-term rentals is a big no-no for CMHC.
Yeah, perfect. Okay, that was a really good question. Wow, we covered a lot there in 1 hour. Just very briefly, guys, let's thank Brendan so much for his time. That was very valuable. We really wanted to give the actual details, how this actually works, things we're actually learning, and challenges that we're actually having. Now, this leads back to absolutely why we started WealthShare, is because there is a lot of people interested in this space that don't want to go it alone. And we want to be able to bring these types of opportunities to our investors passively. That being said, even though we're offering passive opportunities, we want you to learn with us. And so I think there's a major, value add to being a WealthShare investor to be able to access this, and also all the other types of events that we have coming in the future. We're working on in-person wealth workshops for our investors here at WealthShare. We want to educate and let you know how we are doing as we go. So transparency and accessibility is what we're all about. So very briefly, just to summarize, our offering here. And I also want to point out that David Maxwell is here tonight. If any of there's RAIN members around, know David, and he's going to be reaching out to you guys after the event just to thank you for coming. We'll be offering the recording. If there's any questions, he'll be able to get those answered for you or point you in the right direction. So thanks so much for being here tonight, David. I think he's going to put a link here in the chat if he hasn't already as well. But just quickly, again, our offering, if you're interested in passively investing in these types of institutional level quality multifamily real estate properties like these two. We are just getting started. We are we have acquired over $20 million of real estate in the last year, and our goal is to have a $100 million portfolio inside of the next year. So we need our investors' help to do that. Of course, we have almost 200 investors with us now and growing. So if you're interested to learn more about us, please click the link David has put in the chat there, or reach out to us. And again, it's open to eligible or accredited investors with cash or RRSPs or TFSAs. Those registered accounts absolutely work. And we're offering a 12% projected return with an 8% preferred return. And we're on a continuous raise right now to get to our portfolio goals. So I hope everybody found tonight very valuable. This is the types of things you can expect from WealthShare. We want to share the value as we go. So thanks so much for being here tonight, everybody. And I hope you learned a lot. And thanks again, Brennan. Thanks for joining us and sharing your knowledge with us.
Thanks so much, everyone.